let's talk about inversion fair value gaps, right? What we refer to as Ifvg. Now, this is simply when a candle closes completely above or below a fair value gap. Now we have this here as an example. We have fair value gap like this, bearish candle, wick down, another bearish candle, close, another bearish candle, the wick up, right? So this here, right? This gap inside here is a bearish fair value gap. This gap inside here, this gap inside here where only sellers were present, this is a bearish fair value gap from what I just explained. So now what is an inversion? An inversion is when a candle, a bullish candle in this scenario, since it's a bearish fair value gap, when a bullish candle opens like this and closes completely above the fair value gap. Do you understand? So we have a bullish candle here closing completely above the fair value gap. It filled the fair value gap completely, and that brings us to the next point, which says Ifvg also indicates reversal. So you can use something like this to know that, okay, now if you are bearish, the market is supposed to like respect this PD array, it's supposed to respect this fair value gap and continue down. But in this case, the market traded above, like completely destroyed the fair value gap, traded above this fair value gap. This is also a sign for you to know that, okay, like you're about to maybe get a reversal. Now, the third point says Ifvg can also be used as an entry. How do you use Ifvg as an entry? Same way you use a fair value gap as an entry. Now, in a fair value gap, you want to see the market trade into it and then continue lower, right? Now, for the Ifvg, when we get a complete bullish close above the fair value gap, you want to see something like this, like a minor return into that fair value gap and then continue higher. Do you understand? This is how you use an inversion fair value gap as an entry. I'll give you, let me give you guys an example from a trade I took on Thursday, and I'll attach the screenshot here. So from this gold chart, this gold 4-hour chart here, so we have this, or we had this fair value gap here. So week high, week low. So we had what? Week high here, week low. This, you see this gap? Only buyers were present inside here. Do you understand? No sellers were present inside here. So that becomes what? A bullish fair value gap, because in this scenario, we are bullish, right? We are bullish, and this is what a bullish candle. So we mark that out as a 4-hour fair value gap. Mind you, this is a 4-hour time frame, right? So on Tuesday, rather, that was on Tuesday. So on Tuesday, September 30th, I took this particular trade here, right? So when I saw mind you, at that time, this high was the all-time high, ATH, or label it ATH. At that time, this was the all-time high. And we're in a bullish market situation, right? We're in a bullish market. You see, from down here all the way up here, we are bullish, clearly. Now, I also want to be a buyer in this type of market. I don't want to be selling, right? I want to join the buyers. Now, when I saw the market trading down into this fair value gap, I did not like buy outright, you understand? Because there's also a scenario where the market could do something like this and close lower. You understand? It's also possible for the market to trade lower, close lower as an inversion, and then continue bearish. So I waited for the market to reject away from this 4-hour fair value gap, and then I went to the 15 minutes time frame, which I always use for my entry when I pair it with the 4-hour time frame for my entries. So now this was the all-time high. This here was the 4-hour time frame. The 4-hour FVG. Now, what do we have? So prior to the move down, right? Prior to this move down, the market created what? Bearish fair value gaps. You can see here, right? From this week low, draw it out. to this week high, you notice that what this heavy bearish candle, right? This heavy bearish candle indicated what? Heavy presence of sellers. You understand? So this was a bearish fair value gap. Now, when gold traded into this fair value gap, started trading up, what did it do? Closed completely above this fair value gap. That now became an inversion fair value gap. So when I saw it, I took a buy from here, right? I took a buy inside here, right? Now that's the first one. Like I said, mark out all the bearish fair value gaps and see. This is what? Another bearish fair value gap. Notice how here the market opens, trade with a wick down, body close, wick up, body close. This is an efficient price delivery, right? But here there is no presence of bias. There's no presence of bias here. So when the market first traded above here, this here was my entry. When we closed again above this second fair value gap, that became an inversion fair value gap. When the market traded down into here again, this was the second entry for you. Do you understand? So this is what you do. Close above fair value gap here, trade down. First entry here. First entry, you're targeting what? The all-time highs, because you want to create new all-time highs. So that was first entry right there. Where do you place your stop loss? You place your stop loss just below the inversion fair value gap. Now, in the second one, same thing, same scenario. When the market traded back into the inversion fair value gap, that's where you take your buy. Do you understand? Your first TP is going to be your stop loss first is going to be just below the inversion fair value gap. Where is your first TP? Your first TP is supposed to be just above this particular high that started this bearish move. So this is your first TP here. Mind you, this is like this is a 1:4 trade right here. This second entry alone is a 1:4. If you use this high as your TP, that's a 2.3 arrow. Do you understand? By using just a very simple concept of fair value gaps and inversion. I'll attach the screenshot of the trade I took up here. This particular move alone was over 780 pips I got from this particular move alone. So I hope that was insightful. I'll see you again for the next lectures.